Meine Damen und Herren, es ist mir eine besondere Ehre, Ihnen Herrn Professor Josef Lakonishok vorstellen zu dürfen. Er war bereits dreimal in den vergangenen Jahren bei uns. Er ist einer der bedeutendsten Kapitalmarktforscher weltweit, beschäftigt sich intensiv mit empirischer Kapitalmarktforschung, hat unwahrscheinlich viel veröffentlicht, über 80 wissenschaftliche Beiträge in den führenden Journals wie das Journal of Finance, Journal of Financial Economics, Journal of Business. Also in den internationalen Top-Journals ist er vertreten und wird sehr, sehr viel zitiert. Er ist einer der ganz wenigen Wissenschaftler, der fest in der Praxis verankert ist. Er besitzt mehr als 20 Jahre Investmenterfahrung, hat eine eigene Asset-Management-Firma aufgebaut, LSV Asset Management in Chicago, die heute 90 Milliarden US-Dollar verwalten. Sie sehen schon alleine der Zahl, dass das, was er macht, sehr relevant ist. Er beschäftigt sich dort mit quantitativem Portfoliomanagement, mit einer Value-Expertise. Für seine vielen Veröffentlichungen wurde er vielfältig ausgezeichnet mit dem Smith-Breeden Prize, mit dem Roger F. Murray Award und mit dem American Association of Individual Investors Award. Ich freue mich ganz besonders, dass er heute hier ist zu dem Thema How Smart are Smart Beta Strategies. Joseph, the stage is yours.
Good afternoon. I cannot tell you that I understood what Johan said, but anyway, thank you for whatever you said. And, it's nice to be here, although I'm not sure that so late in the day to talk about smart beta is really so exciting, but we'll try to make it easy. So, as you know, recently, smart beta, fundamental indexation, factor investing, all of those ideas are getting a lot of play. And a lot of money flocks to those strategies. It's not neutral across countries. In some countries like Netherlands, those strategies are maybe more popular. Australia would be another place where the strategies are more popular. In the United States, less than in those two countries, but we definitely see some clients getting interested in those strategies. Where do I switch my thing here? Here, right? I go forward like that. So it kind of summarizes what I think about it. I'm actually quite skeptical about those strategies. And the main premise of all those strategies is that somehow the cap-weighted benchmark, the value-weighted benchmark, is not efficient. And I think some of those guys that are preaching those strategies suggest that it is easily beatable by whatever they are doing. But you know, the cap-weighted benchmark is our aggregate wisdom. If you aggregate across all our holdings, it is a cap-weighted benchmark. And if I am on one side of the benchmark, and I think that I am smart, there is somebody on the other side of the benchmark that by definition has to be not so smart. So it's not really such an easy game. It's also interesting to look at what active money managers achieved. And the research on active money managers is going back many years, and Michael Jensen was really the first one to do a comprehensive study of performance of mutual funds. I think that the study was published around 1972. And when he looked at all the active money managers, the aggregate underperformed the benchmark by roughly 1%, 1.2%, which was more or less consistent with the fees that, you know, the mutual funds are charging and the trading that they were doing and so on. So before expenses, mutual funds were neutral. After expenses, mutual funds, did not really do so well. But there is a huge incentive for active money managers to outperform. And many of them are highly intelligent. Many of them are highly dedicated. Many of them have very strong convictions. But in spite of it, to outperform the benchmark on a consistent way is extremely difficult for money managers. And the ones that are doing it end up making a lot of money, which is definitely a positive, are becoming very recognized in the field. So many of us that are trying to outperform benchmarks, we deviate substantially from those benchmarks. Our portfolios are definitely not cap weighted. And in spite of it, we don't find that to outperform the benchmarks is a very easy task. So I'm very skeptical about this new breed of young, quantitative guys that are coming in with those strategies and over-promising. And if I would have to guess, they will under-deliver. It kind of reminds me my years in academia. I started my money management company in '94. In '96, I was still an active academic in spite of running a money management company. And I was the chairman of a session at some American Finance Association meeting. And I was chairing a session on market anomalies. We didn't call it factor investing. We didn't talk about factors. We talked about anomalies. Anomalies are things that we don't understand. Now we take an anomaly, we make it a factor, and we think that we understand. It is basically what those guys are more or less doing. So there was a session on anomalies. And one paper after another presented amazing results, how easy it is to beat the benchmark. If a paper had an alpha of 5%, this was a low number. Every paper has alphas of 10%, something like that. So at that time, I was a money manager with probably 12 quarters under my belt, a very experienced money manager, and we were doing okay. But every quarter that you outperform, you feel happy about it, you feel fortunate about it, and you don't really take it for granted, and you don't think that it is so easy. So I asked those guys, please tell me, how is it possible that you guys are so smart, and people on the other side, and I counted myself at that time on the other side, are so dumb, and we don't find that outperform the benchmarks is so simple. So I think that actually, interestingly, many of the people that presented at this session eventually became money managers. It was tempting. However, many of them came back to academia, which means that they found that the success on the other side wasn't so simple. It definitely wasn't because Wall Street is paying less than universities, so it's kind of interesting to think about it. But I have to... why the excitement about those strategies? So without any doubt, there is disappointment with active money managers that on average don't deliver. There are some money managers that I'm convinced are doing an amazing job. To find those guys is not so easy. To stick with them during difficult times is also not so easy. So there is definitely a disappointment with active money managers. In addition, there is now a huge sensitivity to fees. You know, fees are just, especially in some countries, Holland is an extremely sensitive place to fees. Australia, fees. They even rank funds based on fees that they're paying. They should rank funds based on performance and not be so sensitive to the fees that they're paying. So another environment which actually benefits some of those strategies, because those strategies tend to be very cheap, or people are offering them at cheap rates. And we talked about it, the idea that somehow cap-weighted benchmarks are inefficient and easily beatable. So let me, because I was given so much time, and so I can maybe just give you a small overview of all those strategies, how they fit in the finance literature. And you will see the main conclusion is that there is nothing new. There is absolutely nothing new. All those ideas are going back 40 years, 30 years, 25 years. Another generation of people my age try to benefit from those strategies without really amazing success. And as I mentioned, many are back in academia and so on. So let me kind of start and talk about some of those strategies. I finished my Ph.D. in 1976, almost 40 years ago. And when I finished my Ph.D., there was only one party in finance. It is a party of efficient markets. Markets were efficient, unbeatable. The only papers that you could publish were papers that glorified the efficient market. It was like the Communist Party in Russia. The editors of the journals were very strict. If you had any interpretation that today we would say is a little bit behavioral, it was very difficult to publish those papers. But the only problem that we really had difficulties with is a relationship between beta and returns. Because at that time we had one model, which was a capital asset pricing model. And the capital asset pricing model suggests that beta is your measure of risk. And per unit of beta, you have to get a compensation, which is a return on the market minus a risk-free rate. But nobody found that the security market line is so steep. We found very meager, mediocre compensation for beta-type risk. The first paper in this area was a paper by Fischer that unfortunately did not get a Nobel Prize in economics. He died prematurely. Then there was Fischer, and Scholes. It's kind of literature going back to the early 70s. So now when people are actually coming to those low vol strategies, mean vol strategies, it's basically stuff that was uncovered much, much earlier. But for some reason, which I will try to explain to you, nobody really used and tried to utilize for many, many years. Then, in 1977, there was another very important paper written by somebody that was a student with me at Cornell University by the name of Joe Basu. The paper was published in Journal of Finance in 1977. And Joe Basu found kind of the first really paper on value investing, which was done with modern statistics and much more comprehensive than what was done before. He found that low PE stocks outperform high PE stocks. I knew Joe Basu very well. He had a lot of ideas, interesting ideas of why it was happening. Of course, a militant group, a Journal of Finance, would not allow him to make those behavioral speculations of why value companies outperform growth companies. So the paper was published, got attention among academics. If you go to the conclusions, it's sort of pathetic, because he had to give up all his nice interpretations that he had. Then we had, so value investing can be traced to Joe Basu, 77. Then we had another interesting development. Rolf Bunz was a student at University of Chicago, and he published a paper on what we later called size effect. Small companies are outperforming large companies. Everybody got excited about it. Everybody was writing papers about the size effect. Probably if you go to my roughly 100 publications, you will find about 5 papers on size effect. So this goes back to 1980. And then we had a lot of papers on anomalies. And then in the early 90s, we had two important papers. Not because I was associated with one, but just because they kind of survived the test of time. It was a paper on value investing that I published with Schleifer and Vishny. And before, I published a paper on value investing in Japan. And then the paper on momentum, which are now, when people are talking about factor investing, those are really the main ideas. So really nothing is new. It goes back so many years. And, you know, as I told you, my generation of academics was also greedy. They also wanted to make more money. They also started money management companies with those ideas of value and momentum and so on. And very few now are in academia, not because they were less skillful than the current breed. They are the ones that came up with those papers. Some of them got Nobel Prizes, but they found that to beat the market was really more difficult than the perceptions that you might be getting from people that are selling those strategies now. So no questions, I just go on, Johan, that's it, talk. If you cannot resist, you can raise your hand. I will focus on a couple of those strategies: low volatility, size, momentum, value, fundamental indexation. You know, it's really not important what the definition of smart beta is, but whoever is selling those strategies, you know, those are sort of the strategies, those are the factors. Recently, quality popped up as a factor. You know, I didn't do anything with quality. I did a lot of work at the company about quality, so if you cannot resist and you want to talk to me about quality, I will be more than happy. So let's start with low volatility. So Johan actually insisted that I update this table because the table was updated till 2012. So you can imagine this very long period of time, adding 2 extra years, what a difference it made in the results, right? So anyway, what we did, we focused on the bigger companies. We classified companies to deciles based on their betas, and we try to see what are the returns. So if you believe in this very basic model in finance that we have, that we call the capital asset pricing model, the return on the market was 11.66, the risk-free rate 3.51, and the risk premium was 8.15, which basically means that for every unit of beta, you should get an extra of 8.15. So if you have a portfolio with a beta of 0.5, and I have a portfolio with a beta of 1.5, I should get by 8% more. If you look at the extremes of those deciles, decile 10 minus decile 1, decile 10 are high betas, and you can see the ex post beta, which means those are the future betas, because we sort on betas, so the ex ante difference in betas is much, much bigger. You will see that the high beta guys have a beta of 161, the low beta 0.64, a difference in beta of 0.97, almost 1. But if you look at the arithmetic means, the difference in returns is 2.4. Very little. Very little. If you go to the geometric mean, it actually becomes negative. I should be a little bit clear about what we are doing. We classify those stocks into 10 portfolios, and it is buy and hold for a whole year. So if we would rebalance all the time, the difference between arithmetic and geometric will shrink, but we are just rebalancing once a year. What you see is not really that the low beta stocks are doing so amazingly well, but the high beta stocks there is absolutely flat. You go to decile 5, 6, 7, 8, 9, you see exactly the same rates of returns. So this is a result that was in the literature forever, and nobody picked it up, nobody did anything with it, till something happened with the financial crisis, and those strategies came more in vogue. Now, it is what happens if you look at the last 20 years, because in money management, we don't really spend so much time on 80 years or 90 years. We always ask what happened in the last 5 years, 10 years, so 20 years. So 20 years, you roughly see the same picture. It's basically only flat. What is really interesting is the poor performance of decile 10. If you look at decile 5 and 1, you see a spread in returns. But, there is nothing between decile 5 and 10. Even 10, the returns are lower. Now, if you would try to analyze what companies penetrate decile 10, you will see a lot of technology companies, a lot of biotech companies, kind of companies with very high skewness, kind of pie-in-the-sky companies, lottery-type companies. And maybe for those companies, there is a demand, too much demand, and and the returns adjust accordingly. So so now, just for completeness, you have the same numbers for standard deviation. So the sort is not on beta, but the sort is on standard deviation. And beta and standard deviation are very highly correlated. So the results for standard deviation and beta are roughly the same. Then what we did internally, kind of in line with strategies which are being sold, we generated a minimum variance portfolio going back to 1979. And we generated a minimum variance portfolio. We stayed with it for a year, and then we rebalanced it. So once more, buy and hold for a year, and then we make some changes. Now, you can generate many minimum variance portfolios. You can do it totally unrestricted. We put some restrictions on sector weights, industry weights, because if you would do it today, you would take every utility in the United States under the sun. So the portfolio probably would be 40–50% utilities. So we put some restrictions on how much we can be overweighted in different industries. What you see here is that basically the minimum variance portfolio and the S&P portfolio have very similar returns. If you look at the geometric mean, the minimum variance is a return which is roughly by 1% higher, 13.2 versus 12.2. Not the experience that people had after the crisis where those strategies outperformed S&P by a lot, but the historical evidence like 1% higher, and a very big difference in beta. The mean vol had a beta of 0.62, and the S&P, of course, has a beta of 1. The number above is telling you why those strategies did not caught on for many, many years. But you can see why those strategies were not so attractive in the past, because those strategies were associated with very big tracking errors. Every time that you have a portfolio that has a beta of 0.6 relative to the market, you have large tracking errors. And so people were not excited about those large tracking errors, and people did not really flock to those strategies. But the strategies became very popular after the financial crisis in 2007, 2008, because you can see that from July 2007, when life started to be more difficult, till December 2008, we could probably extend it by 1 month, by 1 quarter, because things started to turn around at the beginning of the second quarter of 2009. low vol strategies had a return of minus 19.8% annualized, but the S&P minus 27.2. So there were people that pointed out, look, if you would be invested in low beta strategies, you would not suffer the same losses. 0.45 is probably going to be in the top 10–15% of value money managers in terms of exposure to value. So the portfolios were clearly value portfolios. And people that wrote about those strategies, like Bob Hogan, were always saying one reason that those strategies are doing well is simply because those strategies are kind of value strategies. If we do the same regression from 2010 to 2014, you see this measly coefficient of minus 0.03, which means that those strategies are not anymore value strategies. A lot of money flocked to those strategies. Arbitrage forces were at work. All of us looked for safe havens, flight to safety, and you can see that those strategies are not anymore value strategies. So historically, from 1979 to 2014, you see this HML, which is a return on the HML factor, by how much value, the way that Fama and French are defining it, the way that it appears on Ken French's website, value outperformed growth by 4%. There was a swing between 0.45 to minus 0.03, which is roughly 0.5. So if you just multiply it, you assume that the return on the value factor is going to be like it was before, you're supposed to get a return which is by 2% less. So to the extent that you flock to those strategies because of past performance, be aware that those strategies are now much more expensive. Another way to say it is not to look at HML and so on, but look at PE ratios that probably talk to you much more. And I didn't provide you with historical numbers, but if you go to the Morgan Stanley mean vol portfolio, you will see that this portfolio is substantially more expensive than the core benchmarks. So in USA, the PE is 19.7 versus 18. If you go to Morgan Stanley World, it is 20.9 versus 18.4. And then we have ACWI, which includes emerging markets. And even in emerging markets, there was a huge flight to safety. Just look at the values of the breweries, and it's crazy what happened in emerging markets. So don't flock to those strategies because you think that you will get what you got in the past. Those strategies are much more expensive now. So, by the way, most of the money, when people talk about smart beta, and once more, without getting into exactly what is smart beta, most of the money is in low vol strategies, mean vol strategies. This strategy attracted a lot of money. So this is the first one that I talked about, is really the most popular of them all. Now, people talk about size effect. People are saying, if we could just get away from those cap-weighted benchmarks, which give too much weight to the big companies, and we could just become smaller. So, interestingly, from 1927 till 2014, if we take all the companies in the United States, we classify companies to deciles based on New York Stock Exchange breakpoints. Okay, not breakpoints, based on all the companies that are dominated by the micro-cap companies. So the small guys are 1 to 3, the bottom 3 deciles, 4 to 7 is kind of the middle, and 8 to 10, those are the bigger companies. Really not huge companies, but the bigger companies. So from 1927 till 2014, you can see this number 4.9, which means that large companies underperform small companies by 4.9, or small companies outperform large companies by 4.9%. And Fama French have this size factor that they call SMB. It is a portfolio of small cap stocks minus a portfolio of large cap stocks. You come up with a number of 345. When we got excited about those strategies in the early 80s, we saw data from 1927 till 1980, and we saw amazing numbers. 7.9% is a difference, 474 for SMB. People got excited about small cap. DFA got started. It doesn't take hundreds of billions of dollars to arbitrage this inefficiency. We didn't have before small cap funds. Now you have so many small cap funds. And you can see that from 1981 till 2014, you don't see anything. Small companies do not outperform large companies. So those large companies, you know, there is nothing wrong with those companies, that a lot of people that are selling you those strategies are telling you to avoid them. Now, if you don't like those calculations that we did here, just look at US indices. You have Russell 2000, Russell 1000. Those are value-weighted indices of the largest 1,000 companies and the next 2,000 companies. The indices started in 1979. Russell started those indices, including value growth, in 1979. You see that the differences in returns are 0.1%, minus 0.2%, really nothing. So when people are saying cap-weighted benchmarks are grossly inefficient, if we could just get away from it, it's even not important where we go, just get away. You don't see it here. You don't see it here. I started the company in '94, and I wrote a lot of papers about size. And there was some temptation to have a size factor. I didn't do it for a very simple reason. I started to see the success of DFA in raising money. Suddenly, so many small cap funds started to emerge. And you just logically think, how much money do you need to wipe out this inefficiency? Not really a lot. So we can continue, right? Another strategy is momentum. And Jagadish and Titman published in '93 a paper that is extremely well cited, generated subsequently research that is, you know, even difficult to summarize, not in terms of extra contributions, but in terms of papers that were published in academic journals. And once more, the same story. So older data, 27 to 2014. I want to explain it a little bit. WML is also coming from Fama French. It is winners minus losers. It is companies that did well minus the companies that did poorly. How do they decide which company did well, which company did poorly? They go and look at returns in the past 12 months, and they stop in months -2. So -12 to -2. Those portfolios that they are doing are rebalanced monthly. So every month they reshuffle the whole damn thing, a lot of trading. If you would stay with it a little bit longer, the differences in returns would shrink, but it is what they did. So if you do what they did from 1927 to 2014, and you look at the bottom 50%, which means the smallest 50% of the companies. Everything that we found, unfortunately, works better for small companies than large companies. Large companies are more followed, less ignored, and stuff like that. So you get 10.87. If you go to the top 50% of the companies, the biggest 50% of the companies based on New York Stock Exchange breakpoints, you see this number 802, and the Fama French factor WML is 946. The data that Jagadish and Titman saw, the data that all of us saw, kind of ended in 93, probably 91, 92. We saw even higher numbers. Unfortunately, after the papers were published, you see 566. For big companies, you see 396. For their factor, you see 486. Numbers which are at most half of what you saw before. Now, why are they half? Somehow those strategies got lucky, and you will hear tomorrow a presentation by Kem Harvey. He's really a leading academic. He's doing very interesting stuff about the dangers of data mining and data snooping and data torturing. But if you take a lot of data, and you're a good statistician, the data will confess. You will find something that worked in the past. The only problem is, will it really work in the future? So at least for momentum, you don't see the same strength in the past as after the papers were published. And of course, 2003 to 2014, you start seeing negative numbers. It's 12 years. 12 years for a money manager is an eternity. And if you would put your eggs into those momentum ideas, you would probably trade more because those strategies are very intensive on trading. And I don't think that your clients would end up keeping you for a very long time. Now, some people might jump in and say it's really not fair because we had one bad realization for this strategy, which was 2009. And there is now a very interesting paper by Sheridan and Titman about momentum disasters, that the momentum typically does well, but it kind of blows up. But how do you know when it blows up? If you don't know when it blows up, it's kind of a problem. Now, they're suggesting that somehow you can identify when it blows up, but you know, they didn't have so many blow-ups to draw any significant conclusions. So another exciting strategy. I published a paper with Jagadish and Louis Chen about momentum. And I started a money management company and just couldn't get excited about momentum because I don't understand why it works. Now, if you read my paper, we're giving you plenty of explanations why it works. But it was a necessity. You need stories to publish those damn papers. But my conviction about those stories is not very high. So it kind of works. We found that it works in the United States. We found that it works in other countries. We found that it doesn't work in Japan. But we really don't have a good idea why it works. For me, something that works has to be painful. If you chase companies that everybody else is chasing, where is the pain? Quality has the same features. To buy Unilever, a quality company, is easy. To buy Philips, I'm not saying that you should buy Philips. To buy Philips is difficult. But to buy companies which are successful, quality companies, high ROE, high ROA, every measure on quality. So when people come up with those strategies, and we spend a lot of time investigating those strategies, the first thing that I would like to ask them, why do you think it works? You should pay for quality. You should not get a compensation for quality. So the same, you know, actually I'm kind of doing well on time because I want to leave some time for questions. So the same numbers for how momentum works outside the United States, and also much better for smaller companies, less for large companies, and very poorly in the last 12 years. Now, value. Kind of a strategy that is close to my heart. The definition of value that is still predominant in the literature is book to market. So I'm not doing anything more than looking at book to market. So even now, when you go to some of those academic meetings, in spite of all the evidence, when an academic says this is a value company, he doesn't think about high cash flows, high earnings, he thinks about high book. It is, academics are still in this era of book to market being a very good value indicator. So you go back to 1927 till 2014, bottom 50% once more the small companies, top 50% the big companies, and HML is the famous French value factor. So you definitely see very exciting numbers. When people started to do the research, they saw numbers probably till 93, you know, probably not 93, to be fair, probably 1990, because till a paper is accepted and our data was lagged by a whole year and so on. So, but you know, till 93, we saw huge numbers. HML was 558. Now those strategies got attention. Maybe there was some data mining and data snooping that made us excited about the strategies. You see the numbers becoming much less exciting. And even for large companies, top 50%, you see minus 1.05, not a great number. You go to Russell 1000 value minus Russell 1000 growth. From 79, we have like 35 years. It's a lot of years, 35 years. You can see that the difference in arithmetic mean is 0.53. Really nothing. There is something when you go to the small companies, but also 259. Then when you look at the last 12 years, we see negative numbers. So, you know, I'm a little bit of a skeptic when people are selling this type of stuff, because there is very strong evidence that the stuff that worked in the past worked for us, the older generation of people that published those papers, made us excited about those papers. It's diminished by quite a bit. So one more, so here is the same numbers outside the United States. You really don't see any difference. If you look at value minus growth for global companies, you see that for large companies, the number is 1.9. In the last 12 years, 1.19. Nothing really to write home about. Another strategy that people got excited about was sort of pioneered by Rob Arnott and Jason Su. They called it fundamental indexation. The idea was very simple, to get away from cap-weighted benchmarks, because a cap-weighted benchmark is giving a weight to a company based on its market cap. They said, let's give weights based on some fundamental indicators. What are the fundamental indicators? You can pick a lot. They said sales is one of them. Cash flow is another one of them. Book is another one. And I think that they have dividend yield, so they have 4. Although they claim to be very transparent, when you try to replicate it exactly, you encounter all sorts of issues. We spent time just reading published stuff, what they were doing. And then we generated portfolios, and we looked at some of the ETFs which are based on those strategies. And we found a very high correlation between what we came up and between what they are doing. So I think that we replicated it well. But you know, those things are so mechanical. To me, it's a little bit painful. Because you take and you say, I'm going to give weight based on revenues of a company. So a supermarket, which has huge revenues and tiny profit margins, is getting a lot of weight. A pharmaceutical company that has very high profit margins and is not, of course, selling a lot is going to get much less weight. So this kind of robotic weighting scheme is definitely not very attractive. But the bottom line that by doing it, they tilt their portfolios to value companies. And they're a little bit more, and they're more diversified across those indicators than simply loading up on book. So let's look at the success of these strategies. It also attracted quite a lot of money in the United States. So fundamental indexation from 1968 to 2014, we basically did exactly what they are doing, but we traded once a year. We traded once a year, we held this portfolio for a year, we came to the end of the year, we reshuffled it and stuff like that. So you can see that this strategy generated a return of 13.34%. So now we have to decide if it is a good number or it is a bad number. So what we did, we just took portfolios based on simple book. And you know, 1334 is very similar to what you would get if you would be in quartile 3 by book to market. But of course, if you go to our quartile 3, we equally weighted the stocks in those portfolios. So we are much smaller than their portfolio. So we kind of decided to correct it a little bit by actually doing what we call control weighted, giving more weight to bigger companies, but not really excessive big weight. So I don't want to get into details. But you know, you see that you get also something that is very similar to the third quartile. So, and then what we did, we basically took this strategy and regressed it on the 3 Fama-French factors. And you can see that this strategy generated an alpha of basically 0. Nothing. So market minus RF is 0.996, basically suggesting that the beta is 1. SMB, small minus big, is basically 0. But it really loads up on HML, on value. And so it was kind of an unsophisticated value strategy. And I think it is a reason why historically it did well. You know, I should skip this, but it is a very good example. I don't, you know, at some point people were just, everybody was getting, or a lot of people were getting value line. I still get value line today, and value line classifies companies to 5 groups based on what they call timeliness. There are traces of momentum here. Earnings momentum, price momentum. And group 1 are sort of the most timely companies. And you see how they do amazingly well on paper. It is what they publish in their books. Now, if you go to the bottom, you will see the mutual funds that value line created to benefit from this anomaly. because money management is more lucrative than publishing. So at some point in '86, they said, wow, the numbers are so amazing, why don't we do a mutual fund? So even if you look at large companies, you see a number of 9.2, S&P 500 10.4, not very exciting. Of course, there are management fees and cost and stuff like that, but it is just a very good example how it is difficult to translate numbers from paper portfolios to actually real-life portfolios. So those are my conclusions. You know, when I started to publish those papers on anomalies, I really thought that markets are dumb. What did I know? I didn't know better. But you are more and more in the business. You meet those intelligent people that are trying to outperform. You see how difficult it is. Markets are definitely not so stupid. It's very difficult to outperform markets. And beware of people that are selling you products which were back-tested on paper, because there are just so many possibilities and opportunities. You try one procedure, you go to another procedure, and so on. So it kind of leads me to the second conclusion. It is easier to produce alphas on paper than in real life. Every paper that you read, that you find in academic journals, produces highly significant results. Because without highly significant results, you cannot publish those damn papers. But then when you try to implement it, becomes much more complicated. It kind of evaporates. And I'm suggesting that the expectations for the new quantitative strategies might be inflated. There are no easy solutions, no easy ways. And don't necessarily run away from those cap-weighted benchmarks. Any questions?
Hello. Actually, Malcolm Baker published in 2011.
I couldn't hear you.
Yeah. Okay. Malcolm Baker published in 2011 the paper Limits to Arbitrage, explaining the low vol anomaly, and that all people are referring to benchmarks. This is more or less the reason why low vol stocks outperform. Would you agree that investors would do better in the end in terms of a Sharpe ratio if we'd change the risk measure we're using to evaluate strategies?
Yeah, you know, I didn't really say that the Sharpe ratios of those strategies is going to be lousy going forward. I'm not saying it. The only thing that I'm saying is that people flock to those strategies because they saw very high returns. So, you know, I published also papers on the CAPM and stuff like that. Not sure that it is totally arbitraged. But I think on a risk-adjusted basis, you know, maybe something is left. But if you just flock to those strategies because you think that you will get higher returns, I'm very skeptical. And you know, of course, people flock to the index. I actually have a very early paper. I don't even remember where it was published. But we looked at companies that are in the index and companies that are outside the index. And you know, we found that the companies that were outside the index were probably underbought, and companies that were in the index were overbought, and the subsequent returns of companies outside the index were better, although it's a very difficult study because companies that are in the index are very different from companies that are not in the index simply because of size. We focused on S&P 500. It is what we actually did. But it was only true during the period that indexation was growing. But then you reach a stable state. It's not growing anymore. In this case, I didn't really expect to see any differences between in the index, outside the index. So here what worries me also is that there is so much money that flock to those strategies. And those strategies from being cheap became expensive. And the way that people implement those strategies is sometimes also very far from being desired. Like if you do in United States, you cannot avoid utilities. But those damn utilities are very sensitive to interest rates. Can you just imagine what will happen to the utilities if interest rates are going to 3% even? Those low beta companies might become high beta companies. Japan was a very low beta country. It is now not a low beta country. So maybe I wasn't exact, but
part of my question was already answered to some extent, because I would argue like you that we should not judge smart beta strategies only on past performance. I think that's a very important point when talking about low vol or quality or whatever strategy. I think it's much more important to judge whether the overall system to select and weight securities makes sense. So I think this is a very important point also in my opinion.
yeah.
And my question would be, because you argue that so much money is flowing into these strategies,
Yeah.
but there is much more money flowing into cap-weighted indices. I mean, I would say maybe 10, 20, much more money.
Yeah.
And this would make me more concerned than money that flows into low-volt strategies, for example.
Yeah. No, your point is very well taken. So you basically ask two questions. One question, we couldn't judge those strategies very quickly and so on. But, look, and once more, I don't know what money managers that sell those strategies are doing. I just don't know. You, pension plans and so on, probably know it because they come to you. But I can just go by what is really in kind of the literature, the talks that they are giving and so on. I never asked, Cliff Asness, whom I know very, very well, how are you doing it, what are you doing, and so on. But, momentum, take momentum. If the best that you can come up is -12 to -2, after 20 years after Jagadish and Titman published the paper, I'm not very excited. If the best that you can come up when you talk about value is to ignore everything and take book, difficult to be excited. So I think that this breed of people is more focused on statistics, but not to make their hands dirty and get into the data and sort things out and stuff like that. Now, in terms of money that is flocking, the only evidence that you see, it's very difficult to see if the cap-weighted benchmark is overpriced, right? Because you don't have a comparison. You can compare it to the past. So I was sitting outside, I was listening to Johan's presentations. I think that we see P's of about 17 or something like that. And we look if the market as a whole is expensive or cheap relative to the last 20 years. The market is definitely not expensive, but the market is not really overpriced by a lot. And we have one more thing, low interest rates. So people have to park somewhere the money. And unfortunately, sometimes they don't think about the future prospects of private equity and hedge funds. There is so much money that is flowing to those strategies, and you should just think twice. Where are the anomalies that all this money is going to exploit? So, but without any doubt, at least the low vol strategies became much more expensive.
I have a question. I think on page 17, I really missed the market cap return. So we didn't see how did the fundamental return compared to the market return. I basically think there's a big trouble if we leave fundamentals by any means. .com bubble, the bank bubble, maybe now China bulls and India bulls, if they have more than 50% of emerging markets. I think the problem always starts when you leave fundamentals, and this tries to go back to fundamentals. And I think as long as an equal weighted benchmark is better than the market benchmark, there's enough problems in a market benchmark. And as long as there's money flowing in those smart beta strategies, the market benchmark eventually will become much better. Yeah. So don't you think it will help basically to have an efficient market at the end of the day?
So, you know, page 17, I know what page you refer. We didn't have, and we should have, the return on the market portfolio. And probably fundamental indexation somewhat outperformed the return on the market portfolio, simply because from 79 to whatever, there might have been a small value premium. But the strategy is not really, there is not a lot of ingenuity in this strategy. I gave a presentation, a similar presentation in Amsterdam, and Jason Su, that was very instrumental in designing this strategy with Rob Arnold, was sitting next to me. And somebody asked me a question very similar to your question, and asked me, you know, what do you think of this strategy? And I don't know how I ended up responding the way that I responded, but I said, if I would have to choose between putting my money in a cap-weighted benchmark and tilting it a little bit towards value and being a little bit diversified across a couple of indicators and not just book to market, I probably would do it. So he kind of jumped up. He was very happy. He said, can I think of it as your endorsement of what we are doing? I told him, I think that we are doing it better, but this is not really the point. So more philosophically, I think that if you are choosing between a cap-weighted benchmark and fundamental indexation, maybe there is a little bit of a benefit, because it is somewhat of a diversified value strategy. Somebody that is trying to improve a model for 20 years, I kind of cannot get excited when measures like just sales and so on are getting all this weight. And I actually looked at some point, Radio Shack had a bigger weight, it doesn't exist anymore, went under than quite a sizable company because they were selling a lot and not making any money.
So, hier ist noch eine Frage und dann dort und dann haben wir noch gleich die Frage aus dem Publikum. Herr Dr. Gerdes.
Mr. Lakonishok, as I understood, of course, that there's some skepticism on those smart betas. I understand. On the other hand, all those periods naturally end at 2014. It could as well be the case that those data, the diminished return on those strategies, show something about the right end of the spectrum, namely about the last 10 years of market performance. Could be. To actually counter your skepticism a little bit, if you actually end up with a diminished but still existing value premium of like 1 or 2 percentage points, I think that's pretty interesting, of course, in a world where overall returns of any kind of assets and risks are diminished. So if I compare the value premium, whatever is left over, versus absolute market premium, it's probably not a bad picture, because after all, we see, of course, a dramatic contraction of risk premium anyway. And lastly, just to challenge it, if you actually looked at some equity risk premium, you would see a similar diminishing trajectory. You could actually come to the conclusion, after all, recent data show that after all, there is no equity risk premium because it's actually, it's just a fake. Chances are there is. But that would be a very fundamental sort of change in capital market models or whatsoever. So you see, the point there is a strong sort of element of diminishing returns or whatsoever, and chances are there is a bubble in the bond market that is the anomaly, which is actually pretty much affecting all those data.
Yeah, you know, you basically talked about a lot of stuff, but you know, when when I try to think about those value and momentum, it is really important how you define it. So it's kind of an empty argument if there is a value premium or there isn't a value premium. I think that it is so naive to take book and think of it as a measure of value. Let me just talk for a minute about it. You know, book has all the history of a financial statements. But recently, there is a big issue with this book. Why? Because US companies are buying back a lot of shares. And many of the companies that buy back shares are buying it at prices that substantially exceed market prices. What happens as a result? You go to the financial statements and you see treasury stock if they did not mark down the shares. And in many cases, treasury stocks are much bigger than the remaining market book value of equity. A good example is Accenture. It is started from Arthur Andersen, a Chicago-based company. We are located in Chicago. And then bad stuff happened to Arthur Andersen. But Accenture is alive and doing well, and it is a $50 billion company. They have almost no book because they bought back a lot of shares. You go back to Altria, almost no book. Another problem with book, accountants don't like to write down assets. It's kind of the last resort. So you see companies with very high book, and what they have is not book, but junk. They simply did not write it down. And I can go on and on and on. So when somebody comes and they talk to me about value premium, you know, come on, guys. Stop coming up with all those statistics. Just come up with a better definition of what value is.
So, die letzte Frage.
Thanks for a bit of debunking all the smart beta hype. What I would be now interested is, you do value. Value is your thing for the last 20 years. So what do you do? How do you outperform the market, or can you outperform the market? What have you learned in those 20 years? Can we all give up? Should we all just buy passive value-weighted index?
You know, I don't know what Johan told you, but we manage a lot of assets. And clients are not that loyal that they will stay with you with lousy numbers. So we started with zero in 94. We are managing now $94 billion. So we had amazingly good numbers. But you know, every quarter that we see a decent return, we don't take it for granted. It's difficult. And we try to improve our models, we try to be consistent, we try to be humble about what we are doing, and we constantly try to improve. So I definitely think that you can do it, but you cannot do it just with pure statistics and math. You know, maybe D. Shaw can run their operation where the half-life of their strategies is 10 days, and just do it with correlations and statistics and just doing this type of, when you turn to long-term investment, there is a little bit more to it. So.
This leads us to the last question. It's basically related. How are you trying to beat the markets in your firm if you are so pessimistic about anomalies?
No, I'm not pessimistic about anomalies. I have a couple of clients here, so a lot of the anomalies are actually in the model. But you constantly try to improve what you are doing. You know, there is a lot of information in financial statements which has to be utilized, and you cannot just, you know, we are lucky that quants hate accounting. It is probably the best thing, because otherwise competition would be more difficult. I have one lady that works for me. She is like the best statistician that you can find, the best programmer. When it comes to balance sheet items, income statement items, after working for 23 years with me, she doesn't like to deal with it. So I try to explain to her. So every time that I'm making the call and I know that I will have to explain some accounting concept, I know that it will last for the next 2 hours, because she typically also doesn't give up. So,
so thank you very much, Josef.